Hello and welcome to this week's Macro Sutra. I'm Yuthika Bhargava and we have with us Radhika Pandey, Associate Professor at National Institute of Public Finance and Policy, to discuss with us risks and challenges to the global economy. Radhika, we'll start with the recent IMF report that has come out on global economy. Can you give us a gist of it, a snapshot, so to say? What does the report say, particularly about recession, since there were a lot of fears on recessions? Have the risks receded? What does the report say?
Yes, so the International Monetary Fund comes up with the World Economic Outlook. It's a report on the health of the global economy, and this report comes out twice a year, one in the month of April and one in the month of October. And in addition, there's a update that happens in July, which is just an update of some of the projection that about global economy that the IMF has made in April. So now, last week, as part of the meetings at the World Bank and the fund, where Ministry of Finance representatives, including our finance minister, have also gone, as part of that, the International Monetary Fund released its World Economic Outlook. That's a report on the global economic growth. And what it says is that global growth is projected at 3.2% for the current year. So it's stable. It's not increasing, it's not reducing. But the good news is that the recession fears have not materialized. So recession concerns have been averted to a great extent, because there was this concern, particularly in last year and last to last year, that because of geopolitical tensions and then because of the sustained monetary policy tightening that various central banks, US Fed undertook, it would eventually lead to a hard landing for the global economy, meaning thereby that there would be recession, because interest rates would rise so high that it will lead to tightening, and it will lead to tight financial condition, leading to slowdown, leading to recession, and also leading to high unemployment. But all those fears did not materialize, and if we particularly look at the US economy, it has performed quite well till now. The increase in interest rates have not actually resulted in slowdown of the economy, and even if we look at the labor market, it has remained quite robust. There have been some signs of weakness, but overall the US economy has remained robust, and that's why we don't see signs of recession. In the EU, in contrast, there has been slowdown, particularly in Germany. We have seen sustained periods of slowdown. Therefore, if we talk about the global economy as a whole, growth is projected at 3.2%, but within advanced economies, while the US is growing at a solid pace this year, the EU is not growing, and so that is the reason why there is some variation country-wise. It's not that the entire set of advanced economies is growing. US is growing, EU is not growing. That is within the advanced economy setup. If we talk about emerging markets and developing economies, India is doing well as per the IMF. India is expected to post a growth of 7% this year and 6.5% next year. But some of the countries, particularly in Central Asia, which have borne the brunt of the geopolitical conflicts, they are expected to slow down this year. And hopefully next year, the IMF says that when these shocks fade, the disruptions to growth fade, there will be improvements in growth. So again, there is a variation country level, but at the overall global growth level, growth is projected to remain stable at 3.2%, both this year as well as next year. So that is the assessment of the global economy at an aggregate level by the World Economic Outlook.
Radhika, you also mentioned that this report says world economy growth will be stable.
Right.
But what are some of the risks? Is geopolitical tension the only risk? How big a risk that is? And what are some of the other risks?
Yeah, so that's very important, because while they say that the global economy is expected to grow at a stable pace, but there are a lot of risks and challenges that could push this growth down. One, of course, is the geopolitical tensions, which could lead to spikes in commodity prices. It could lead to volatility in global crude oil prices. It could lead to volatility in food prices, and that we have already seen in last month. If we look at the food price index, the global food price index, which is released by the UN Food and Agricultural Organization, we see that in September the overall food price index rose at its sharpest pace, and that is again due to broad-based growth. Vegetable oil prices rose, cereal prices rose, sugar prices rose, milk prices rose. So there are these upside, the shift in prices, which could cause 3.2% growth could also be lower than that. So one is geopolitical risk, which would lead to volatility in commodity prices. The other risk that they are pointing out is that because there will be these disruptions to inflation, central banks may not continue, may have to delay their monetary policy easing, because they have kept the interest rates at a high level and they have already started reducing. But if there are these continuous pressures on inflation due to commodity prices, due to oil prices, then they would have to step back on their monetary policy easing, and they would have to keep interest rates elevated for a long time. And that would again tighten the financial conditions, that would make borrowings costlier, and that would curb demand and delay economic recovery. So that is the second risk that they are pointing out. And the third important risk that they are pointing out is that globally economies are resorting to protectionism. Because of the, again, as a consequence of geopolitics, most of the economies, US is resorting to protectionism, China is resorting, India is resorting to protectionism. So it will increase the trade cost, and particularly for those economies that rely on other economies for, say, access to technology or access to innovation, they will suffer and their economic growth will be slower. So geopolitical tensions, delay in monetary easing, which is very crucial for economic recovery, and the pick up in this trend of protectionism, moving away or retreating from free trade. These are some of the risks to global growth that the report points out, and that could pose downside risks to this 3.2% growth.
The report also mentioned about debt.
Right.
It says global debt will touch USD 100 trillion 2024. So how alarming is this number, and what repercussions can this high level of debt have?
Yeah, so that's the other report that the IMF has released. So one is the World Economic Outlook. The other important report that they have released is called the Fiscal Monitor, which is capturing the fiscal policy of the various countries, again, advanced economies, emerging economies, African nations. They are talking about fiscal deficit and debt levels. And there, the concerning assessment is there that the global debt is projected to rise to $100 trillion this year, which amounts to 93% of GDP. And it's not that it's going to stop at this level, it is expected to rise even further in the medium term. So that is a cause of concern, because what's happening is that now there's a lot of spending pressure on economies. There is spending pressure due to cyclical slowdown, but more importantly, there is spending pressure because of the green transition. Most of the economies have to move towards green economy. They have to transition to greener economy, and that would require additional spending. The other driver of additional spending is that we are moving to aging population. The demographic dividend is slowly fading away, and in most of the economies, the population is aging, and that would require, again, additional expenditure on health. And the third important driver of spending is, of course, due to the energy and security concern, spending will increase. So on the one side, government expenditures are going to rise because of these emerging structural reasons. On the other side, it's not very easy to raise taxes. There is political resistance to taxes. Also, because there are elections in so many countries, we are going to see US elections next week. So there is a resistance to taxation, but at the same time, expenditure is rising. So in that scenario, there is likelihood of debt and deficit to rise further. So that is important, and the report actually highlights a few countries where the position is more problematic, and there it's mainly driven by the US. In the US, if we look at the projections that they have put out for the US, it's actually the debt to GDP ratio is increasing, and it's going to rise in the next couple of years. It may rise to 130% of GDP, which is quite alarming. And the important point is that because US is such a systemically important economy, the elevated debt levels of the US is not just going to harm the US economy, it will have repercussions for other economies as well, because US dollar is the reserve currency, and a lot of emerging market sovereign bond yields like Indian government bond yields also mirror the trends in whatever is happening in the US. So if the US bond yields rise, our 10-year bond yield also rise. So our cost of debt also rises. So there is a greater correlation between what is happening in the US and its repercussions or implications for emerging market economies. So it's not just that domestically factors are responsible for the rising debt and deficit. Those economies where there is greater correlation with the trajectory of the US bond yield, the expectation is going to be, the implication is going to be more severe. So they have highlighted US, UK, France as some of the advanced economies where debt is projected to rise at an alarming pace. And one novel feature that they have introduced in this report is what is called the debt at risk. What does this mean is that, they are saying that even these projections may not be true, and they may underestimate the true extent of debt because there's so many uncertainties. So in an adverse case scenario, debt will rise at an even sharper pace as compared to what they are projecting. So overall, in a nutshell, global debt is going to be more problematic, and it could slow down the pace of economic recovery if necessary fiscal adjustments are not undertaken, if countries do not focus on having well-designed fiscal rules on how to cut down on their spending and how to enhance their tax base. So if they do not do so, debt is going to rise at a very sharp pace, and the implications for the rising US debt would be felt not only in the US but in other countries as well.
So, Radhika, what about India then? You mentioned that IMF has stated India will grow at 7%.
Right.
Is there anything else that they are saying about Indian economy? Do we anticipate a slowdown? If you could give a snapshot of that.
Correct. So, as I mentioned, the IMF states that for the current year, growth is projected at 7%, which is close to what the RBI is saying for India, which is 7.2%. Now, if we look at the first quarter growth numbers, because that we already have, they were released on 31st of August. So we know that the first quarter growth has already slowed down to 6.7%. And that was mainly because that was the period of election-related uncertainty. Government could not spend more because of the election code of conduct. But going forward, if we look at the July to September quarter also, we see, if we look at the various high frequency indicators to get a sense of what is the state of the Indian economy, we see that particularly the urban demand is not picking up. Now, if we look at various indicators of urban demand, namely like car sale, like airline traffic, like bank credit, personal loans, which used to be the key driver of bank credit growth till a couple of months back, is declining. So, personal loan, car sales, airline traffics, HSBC, PMI manufacturing, PMI services, or most of these indicators are signaling that there is a slowdown, particularly in the urban economy, urban part of the economy. And more importantly, if we look at some of the commentary made by the consumer good companies like Hindustan Unilever, they are saying that while the rural demand is picking up, because this time the monsoon has been good, so rural demand is picking up, but urban demand is not picking up. So there is a problem in terms of the overall broad-based growth. So there could be a possibility that this growth assumption that the IMF has made, it is optimistic. We may not be able to achieve 7%, maybe 6.8 or 6.7%, because currently what the projections or what the high frequency indicators are telling us, they are signaling a slowdown. Of course, there will be some improvement due to the festival effect. For example, the October-December quarter could see a spurt in spending. We generally see around festival period, there is an improvement in urban demand. But whether it's just a one-off thing or whether that momentum is sustained needs to be seen. But as of now, if we look at the host of high-frequency indicators, they are not showing a pickup in demand. Particularly, urban demand is the thing that is going to be a challenging element.
Radhika, till some time back, we were talking about how rural demand has been slow, and now we are talking about urban demand being slow.
Right.
But does rural demand coming back sort of mitigate the urban slowdown, or?
So, to some extent, yes, because rural demand has been picking up. And if we look at some of the indicators of rural demand, they are showing a pickup. But for, we need to see a broad-based growth, because rural demand is highly sensitive to monsoon. It is highly sensitive to agricultural performance. So we cannot just rely on the rural demand for the entire, for the entire GDP or for the entire economy to pick up. So we need to see a broad-based growth. You are right. Earlier, we used to worry more about rural demand because agriculture was not doing well. And now it's the other way around. It's the urban demand. And, the concerning part is that it is showing a slackness for quite a few months now, and it's not picking up. So there seems to be a problem there. And we should recognize that there's a problem. To some extent, it could be mitigated by the festival-related support, but overall, we need to see that whether this momentum is sustained or not. Is there time to start thinking about cutting interest rates or keeping it elevated? So these are the complex policy decisions that will come into play in the coming months. But as of now, we see that the growth projection by the RBI, by the IMF look optimistic.
So my next question was on policy actions that now need to be taken, because we are seeing more challenges than good news. So in addition to rate cuts that you already mentioned, what are the other things globally, also countries, as well as if you could focus on India, what now needs to be done?
Correct. So again, going back to the fiscal monitor, the report provides a very nuanced assessment of what kind of policy prescriptions are needed for emerging economies and for advanced economies. But first, if we step back, what happened in 2022 after COVID shock, we saw that fiscal policy was easing and monetary policy was tightening. Support was provided in the form of additional expenditure. And we are not talking about India here. In general, fiscal policy was easing and monetary policy was tightening because inflation was rising. Now, the policy prescription is that now the fiscal policy needs to tighten up a bit because debt is rising, deficits are rising. So fiscal policy should become more tighter in the sense that expenditures need to be curtailed and revenue base need to be enhanced. And at the same time, we should move towards monetary policy easing. That journey of monetary policy easing that has already been undertaken, it should not be delayed. Otherwise, economic recovery will hit a roadblock. So earlier, the policy prescription was fiscal policy easing, monetary tightening, and now it's the other way around, that now fiscal policy should tighten and monetary policy should ease based on the inflation trajectory. So that is the thing. But when we talk about fiscal policy tightening, for advanced economies, the policy prescription is that the expenditures should be curtailed because there is an increase in expenditures. Some of the unproductive expenditure needs to be curtailed. There needs to be reprioritization of expenditures. But for emerging markets and for developing economies, the report prescribes that there should be some measure towards enhancing the revenue base. So there is still a scope, which may not be the case for advanced economies. There may not be a scope for increasing the tax base, reducing the exemptions, but that is more so for emerging markets. So emerging markets, the policy prescription is more towards looking at augmenting the sources of revenue, rationalizing increasing the tax base, cutting down on exemption in general for the EM as a whole, for the emerging markets as a whole. So those are some of the policy prescriptions that the fiscal monitor prescribes.
Okay. On that note, Radhika, we come to an end of this session. Hope you found it informative. Thank you so much for joining us. See you again next week.